Mr. Secretary, So it was reported this morning that Amazon will soon display a little number next to the price of each product that shows how much the Trump tariffs are adding to the cost of each product. On Amazon, in this report, that Amazon might start listing the additional cost on specific items put in place by the tariffs. The president is clearly angry. White House Press Secretary Caroline Leavitt said she had spoken to him about it this morning phone call between the president and the founder of Amazon, Jeff Bezos sources, telling CNN that the president at one point wasn't happy earlier today about a report he saw regarding the online retail giant. Got off the phone with the president about Amazon's announcement. This is a hostile and political act by Amazon. Why did Amazon do this when the Biden administration hiked inflation to the highest level in 40 years? Amazon has partnered with a Chinese propaganda arm. Amazon is pulling back from America's supply chain driven not by competition or regulations, but by President Trump's harsh tariffs. These steep import taxes have spiked costs, forcing Amazon, which holds 40% of U.S. e-commerce, to shift operations to lower-cost countries. This retreat exposes a flaw in Trump's plan to boost American industry as jobs and investments flow overseas. Instead, reports including one from Bloomberg show major companies cutting U.S. imports by 20% in 2025 due to these policies. By mid-2026, experts predict e-commerce giants like eBay and Alibaba will slash their U.S. supply chains by 30%, weakening America's role in global trade. In April 2025, President Donald Trump unleashed a bold trade policy that sent shockwaves through the global economy. He imposed a 10% tariff on all imports entering the United States and a staggering 145% tax targeted goods from China, the world's largest manufacturing hub. This dramatic move, described by analysts as economic warfare, disrupted supply chains worldwide. The tariffs created an urgent crisis for Amazon, a titan controlling 40% of U.S. e-commerce. Within 2 months, the company launched a massive restructuring of over $13 billion in supply chain contracts to shield itself from rising costs. The tariffs hit hard, inflating the price of everyday goods Americans rely on, such as smartphones, laptops, clothing, and household appliances. A Reuters report estimates that the cost of importing electronics alone surged by 25% due to the 145% tariff on Chinese goods. Amazon, known for low prices and lightning-fast delivery, faced a stark choice: absorb the losses or pass them on to customers. Neither option was sustainable. Amazon acted swiftly to protect its business, slashing contracts with suppliers tied to high-cost imports and rethinking its global logistics strategy. This wasn't just a minor adjustment. It marked a seismic shift in Amazon's operations. The company, which thrives on efficiency, could no longer rely on its existing network of suppliers and shipping routes. Instead, it began redirecting resources to avoid the crushing tariffs. Contracts worth billions were renegotiated or cancelled, and new partnerships were forged in regions less affected by U.S. trade policies. As reported by Bloomberg, this restructuring reflects a broader trend among multinational corporations scrambling to adapt to America's unpredictable trade landscape. The scale of Trump's tariffs dwarfs earlier trade measures. In 2018, his administration imposed a 25% tariff on Chinese goods, which strained supply chains but allowed companies like Amazon to adapt through price adjustments or supplier negotiations. The 145% tariff, however, is a game-changer. It's not just a tax. It's a barrier that makes importing from China nearly impossible for many businesses. Smaller companies unable to absorb the costs face bankruptcy risks, while giants like Amazon are forced to overhaul their entire systems. The $13 billion restructuring completed in 2 months underscores the tariff's disruptive power. Amazon's response highlights the limits of protectionist policies. Trump aimed to revive American manufacturing by making foreign goods less competitive. Yet, the immediate fallout suggests otherwise. Instead of spurring domestic production, the tariffs push companies to find workarounds outside the US market. A Wall Street Journal analysis notes that US import volumes dropped by 15% in the first half of 2025 as companies like Amazon rerouted their operations to avoid the financial hit. This shift doesn't just affect Amazon, it signals a broader retreat by global businesses from US sea-centric trade routes. The ripple effects are already reshaping commerce. Supply chains that once funneled goods through US ports are being redrawn with Asia to North America trade corridors bearing the brunt. Amazon's $13 billion overhaul involved cancelling contracts with dozens of suppliers and redirecting billions in investments to alternative sourcing regions while protecting Amazon's bottom line. This move raises questions about the long-term health of US trade infrastructure. Ports, trucking companies, and warehouses dependent on Amazon's import volume are now feeling the strain with reduced activity reported across major logistics hubs. Trump's administration defends the tariffs as a tool to strengthen America's economy. Treasury Secretary Scott Bessent, in a recent statement, argued that the taxes pressure foreign competitors and create leverage for US negotiators. However, economists disagree. A study by the Peterson Institute for International Economics projects that the tariffs will cost US businesses $50 billion annually in additional expenses. With little evidence of new manufacturing jobs emerging, Amazon's restructuring, which is far from bringing production to American soil, shows how companies are sidestepping the US entirely to maintain profitability. Consumers are also starting to feel the pinch. While Amazon has so far shielded shoppers from immediate price hikes, the increased import costs are unsustainable. Retail analysts warned that goods like electronics and clothing could see price increases of 10% to 20% by early 2026 if the tariffs remain in place. For a company like Amazon, which serves millions of customers daily, these higher costs could erode its competitive edge. The decision to restructure $13 billion in contracts buys time, but it's a temporary fix for a deeper problem, rooted in trade policy. The geopolitical stakes are equally high. The tariffs aim to weaken China's economic dominance, but they risk alienating a key trading partner. China, which supplies 30% of US imports, is not standing still. Beijing has already strengthened trade ties with other regions, reducing its reliance on the American market. A Financial Times report indicates that Chinese exporters are negotiating new deals with Asian and European partners to offset losses from the US tariffs. Amazon's pivot away from Chinese suppliers aligns with this trend, further isolating the US from global trade networks. Looking ahead, Amazon's restructuring is just the beginning. Experts predict the company will redirect another $10 billion in supply chain contracts by the third quarter of 2025 as it navigates the tariff landscape. This shift could reshape trade flows across the Pacific, with Asia to North America routes becoming less dependent on US ports. Other e-commerce giants like Walmart and Target will likely follow suit, amplifying the impact of tariffs. The result could be a permanent realignment of global commerce, with the US losing influence over key supply chains. The tariffs also expose a paradox in Trump's trade strategy. While designed to protect American workers, they drive companies to invest elsewhere. The absence of new factories or jobs in the US suggests that protectionism may backfire. Instead of strengthening the economy, the policy pushes giants like Amazon to prioritize survival over loyalty to American markets. If this continues, the US could face a diminished role in global trade as businesses seek stability in less restrictive regions. Amazon's $13 billion overhaul is a wake-up call. It shows how quickly global companies can adapt to policy shifts and how those adaptations can bypass the US economy. The tariffs meant to assert American strength are reshaping trade in ways that may weaken it. According to trade analysts, by mid-2026, if the policy persists, the US could see a 20% drop in its share of global import traffic. Amazon's bold move keeps it afloat, but the broader consequences for America's economic future remain uncertain. A quiet but profound shift is reshaping global trade as Amazon redirects its supply chain from American ports to new hubs in Mexico, India, and Vietnam. While these countries see a surge in factories and distribution centers, the once bustling ports of Los Angeles and Long Beach face a troubling slowdown, with workers bearing the brunt of the decline. This transformation, driven by President Trump's tariffs, is not just a corporate pivot. It signals a deeper erosion of America's role as a global trade powerhouse. By investing heavily abroad, Amazon is boosting economies in developing nations. However, the cost is clear: US port cities and their workers are being left behind. Los Angeles and Long Beach served as the backbone of US trade for decades, processing millions of containers from Asia annually. These ports were critical to Amazon's ability to deliver goods quickly and cheaply to American consumers. In 2025, however, activity at these hubs has plummeted. Reuters reported industry data shows a 22% drop in container traffic through Los Angeles this year, a direct result of Amazon rerouting shipments to avoid US tariffs. Fewer ships mean fewer jobs as demand for dockers, truck drivers, and warehouse workers fades, threatening the livelihoods of thousands in California's port communities. Across the border, Mexico is emerging as a new linchpin in Amazon's North American strategy. The company has rapidly expanded its presence in northern states like Tijuana and Monterrey, where new distribution centers are sprouting. A Bloomberg report estimates a 35% increase in logistics facilities in Mexico in 2025, driven by Amazon's need for cost-effective routes into the US market. These centers allow goods to cross the border by land, bypassing the high tariffs on seabound imports from Asia. Mexico's proximity, lower labor costs, and favorable trade agreements make it an ideal hub for Amazon's restructured supply chain. India and Vietnam are also gaining ground as key players in Amazon's global network. Both countries offer low-cost manufacturing and government incentives, attracting billions in corporate investment. A World Bank analysis highlights Vietnam's export sector growing by 18% in 2024, fueled by companies like Amazon shifting production from China. With its vast workforce and improving infrastructure, India is becoming a significant source of electronics and apparel. These nations are not just temporary alternatives, they are becoming permanent fixtures in Amazon's supply chain, reshaping global trade patterns. This shift delivers significant economic benefits to Mexico, India, and Vietnam. New factories and warehouses create jobs, boost local economies, and position these countries as vital links in global commerce. For instance, the influx of Amazon facilities has spurred growth in Mexico's construction, transportation, and retail sectors. Vietnam's manufacturing boom draws skilled workers to urban centers, while India's tech hubs are gaining contracts for high-value goods. These developments strengthen the economic standing of these nations, allowing them to compete for influence in global markets, once dominated by the US and China. In contrast, the slowdown at US ports is creating a ripple effect of economic pain. Communities in Los Angeles and Long Beach, where port-related jobs support tens of thousands of families, are grappling with uncertainty. The decline in container traffic has reduced work hours for dock workers and drivers, with local businesses like trucking firms and diners feeling the pinch. A study by the Port of Los Angeles estimates that every 10% drop in container volume cuts approximately 5,000 jobs in the region, with a 22% reduction already in 2025. The human toll is evident as workers face layoffs or reduced wages. The broader implications are just as concerning. The US has long relied on its ports as gateways to global trade, giving it leverage over supply chains. As Amazon and other companies shift operations abroad, that leverage weakens. A Financial Times report warns that the US could lose 10% of its global trade influence by 2027 if current trends continue. Mexico, India, and Vietnam are filling the gap as manufacturing or logistics hubs and strategic players in a new trade order. This shift challenges America's ability to dictate terms in global commerce, a role it has held for decades. Amazon's investments abroad also highlight the limits of Trump's protectionist agenda. The tariffs were meant to bring manufacturing back to American soil, but they've pushed companies to seek alternatives overseas. Unlike China, which faces the heaviest tariffs, countries like Mexico and Vietnam benefit from trade agreements like the USMCA or ASEAN partnerships, making them attractive for companies dodging US taxes. Amazon's new facilities in these regions are long-term commitments, not temporary fixes. This suggests that the tariffs are reshaping global trade in ways that may outlast Trump's presidency. The economic contrast between the US and its new competitors is stark. While Mexico's border cities buzz with construction and job growth, California's port regions face declining tax revenues and business closures. In Long Beach, local officials report a 15% drop in port-related economic activity, threatening funding for schools and public services. Meanwhile, Vietnam's export hubs are seeing record investment, with Amazon's factories boosting local GDP by an estimated 2% in 2025. India's logistics sector is projected to grow 12% annually, driven by e-commerce giants like Amazon. Looking ahead, this realignment is set to accelerate. By mid-2026, trade experts predict Mexico will overtake several US ports as Amazon's primary logistics hub in North America. This shift could lead to a further 15% reduction in jobs at American ports as fewer goods flow through Los Angeles and Long Beach. The docks that once powered America's consumer economy may become relics of a bygone era, while new trade routes through Guadalajara and Hanoi take center stage. This is not just a logistical change, it's a geopolitical turning point that could redefine global economic power. Amazon's pivot also raises questions about the future of US workers. As jobs move to lower-wage countries, American dock workers and truckers face an uncertain future. Retraining programs or new industries could help, but these take time and investment, which are currently lacking. The tariffs intended to protect American labor are instead shifting opportunities abroad, leaving workers in port cities to navigate a shrinking job market. This disconnect between policy goals and outcomes underscores the challenges of protectionism in a globalized world. The stakes extend beyond economics to geopolitics. As Mexico, India, and Vietnam gain prominence, they strengthen ties with other global players, including the European Union and ASEAN nations. This could dilute US influence in trade negotiations and weaken its ability to shape global supply chains. A Brookings Institution report suggests that countries hosting Amazon's new hubs will likely align more closely with international trade blocs, potentially sidelining the US in future agreements. The tariffs meant to assert American dominance may instead accelerate a shift in global economic power. By mid-2026, the transformation will likely be irreversible. Mexico's role as Amazon's North American hub will solidify with new facilities handling 30% of the company's regional shipments. Vietnam and India will account for a growing share of Amazon's global production, further reducing US port activity. Los Angeles and Long Beach's decline in job losses will test the resilience of America's trade infrastructure. For now, Amazon's strategic shift keeps its business thriving, but it leaves the US economy grappling with the unintended consequences of its policies. Across the United States, major retailers like Walmart, Target, Home Depot, and Mattel are sounding alarms that signal trouble for American consumers. These household names warn that prices for everyday goods are climbing, while some Products may vanish from shelves entirely. This shift stems not from market trends or seasonal changes, but from the heavy tariffs imposed by President Trump's administration in 2025, which have inflated the cost of imported goods. These policies aimed at protecting U.S. industries are squeezing families and threatening economic stability. As retailers struggle to adapt, the fallout reshapes consumer habits and fuels broader concerns about America's financial future. The tariffs, particularly the 145% tax on Chinese imports, have disrupted the supply chains.